A real estate bubble. A property bubble is a type of economic bubble that occurs periodically in local or global real estate markets, typically following a land boom. A land boom is the rapid increase in the market price of real properties such as housing until they reach unsustainable levels and then decline in a bubble. The questions of whether real estate bubbles can be identified and prevented, and whether they have broader macroeconomic significance are answered differently by schools of economic thought, as detailed below. The financial crisis of 2007-08 was related to the bursting of real estate bubbles which had begun during the 2000s around the world. Bubbles in housing markets are more critical than stock market bubbles. Historically, equity price busts occur on average every 13 years, lasts for 2.5 years, and result in about 4% loss in GDP. Housing price busts are less frequent but last nearly twice as long and lead to output losses that are twice as large. A recent laboratory experimental study also shows that, compared to financial markets, real estate markets involve longer boom and bust periods. Identification and prevention. As with all types of economic bubbles, disagreement exists over whether or not a real estate bubble can be identified or predicted, then perhaps prevented. Speculative bubbles are persistent, systematic and increasing deviations of actual prices from the fundamental values. Bubbles can often be hard to identify, even after the fact, due to difficulty in accurately estimating intrinsic values. In real estate, fundamentals can be estimated from rental yields are based on a regression of actual prices on a set of demand and/or supply variables. Within mainstream economics, it can be posed that real estate bubbles cannot be identified as they occur and cannot or should not be prevented, with government and central bank policy rather cleaning up after the bubble bursts. American economist Robert Shiller of the Case-Shiller Home Price Index of home prices in 20 metro cities across the United States indicated on May 31, 2011 that a home price double dip confirmed, and British magazine The Economist argue that housing market indicators can be used to identify real estate bubbles. Some argue further that governments and central banks can and should take action to prevent bubbles from forming, or to deflate existing bubbles. Macroeconomic significance. Within mainstream economics, economic bubbles, and in particular real estate bubbles, are not considered major concerns. Within some schools of heterodox economics, by contrast, real estate bubbles are considered of critical importance and a fundamental cause of financial crises and ensuing economic crises. The predominating economic perspective is that economic bubbles result in a temporary boost in wealth and a redistribution of wealth. When prices increase, there is a positive wealth effect, and when they decline, there is a negative wealth effect. These effects can be smoothed by counter-cyclical monetary and fiscal policies. The ultimate effect on owners who bought before the bubble formed and did not sell is zero. Those who bought when low and sold high profited, whereas those who bought high and sold low held until the price fell lost money. This redistribution of wealth is of little macroeconomic significance. In some schools of heterodox economics, notably Austrian economics and post-Keynesian economics, real estate bubbles are seen as an example of credit bubbles because property owners generally use borrowed money to purchase property, in the form of mortgages. These are then argued to cause financial and hence economic crises. This is first argued empirically. Numerous real estate bubbles have been followed by economic slumps, and it is argued that there is a cause-effect relationship between these. The post-Keynesian theory of debt deflation takes a demand-side view, arguing that property owners not only feel richer but borrow to consume against the increased value of the property by taking out a home equity line of credit, for instance, or speculate by buying property with borrowed money in the expectation that it will rise in value. When the bubble bursts, the value of the property decreases but not the level of debt. The burden of repaying a defaulting on the loan depresses aggregate demand, it is argued, and constitutes the proximate cause of the subsequent economic slump. Recent real estate bubbles. 1990, Japan. The crash of the Japanese asset price bubble from 1990 on has been very damaging to the Japanese economy. The crash in 2005 affected Shanghai, China's largest city. In comparison to the stock market bubbles, real estate bubbles take longer to deflate. Prices decline slower because the real estate market is less liquid. Commercial real estate generally moves in tandem with the residential properties, since both are affected by many of same factors e.g., and share the wealth effect of booms. Therefore, this article focuses on housing bubbles and mentions other sectors only when the situation differs. 2007. Many countries. As of 2007, real estate bubbles had existed in the recent past or were widely believed to still exist in many parts of the world, especially in Austria, the United States, Malta, Argentina, Britain, Jamaica, Micronesia, Ethiopia, Netherlands, Italy, Equatorial Guinea, Monaco, Turkey, Faroe Islands, Brazil, Denmark, Philippines, Fiji, Dominica, Iceland, Nauru, Greenland, Liechtenstein, Canada, Germany, Portugal, New Zealand, Zaire, Latvia, Ireland, Spain, Sri Lanka, Guinea-Bissau, Indonesia, Lebanon, Japan, Bahrain, Iraq, Iran, Timor-Leste, France, Afghanistan, Luxembourg, Bangladesh, Tuvalu, Andorra, Azerbaijan, Jordan, Oman, Venezuela, Mexico, Gibraltar, Poland, South Africa, Turkmenistan, Israel, Greece, Outer Mongolia, Mozambique, Bahamas, Mali, El Salvador, Botswana, Algeria, Laos, Yemen, Bulgaria, Norway, Singapore, South Korea, North Korea, Baltic States, Thailand, Swaziland, India, Hong Kong, Romania, Zimbabwe, Vatican City, Ukraine, China and Croatia. Then U.S. Federal Reserve Chairman Alan Greenspan said in mid-2005 that, at a minimum, there's a little froth. It's hard not to see that there are a lot of local bubbles. The Economist magazine, writing at the same time, went further, saying, the worldwide rise in house prices is the biggest bubble in history. Real estate bubbles are invariably followed by severe price decreases that can result in many owners holding mortgages that exceed the value of the homes. 11.1 million residential properties, or 23.1% of all U.S. homes, were in negative equity at Dec. 31, 2010. Commercial property values remained around 35% below the mid-2007 peak in the United Kingdom. As a result, banks have become less willing to hold large amounts of property-backed debt, likely a key issue affecting the worldwide recovery in the short term. Real estate bubbles in the 2000s. By 2006, most areas of the world were thought to be in a bubble state, although this hypothesis, based upon the observation of similar patterns in real estate markets of a wide variety of countries, was subject to controversy. Such patterns include those of overvaluation and, by extension, excessive borrowing based on those overvaluations. The subprime mortgage crisis, alongside its impacts and effects on economies in various nations, has implied that these trends might have some common characteristics. For individual countries, see Australian property bubble 1994 to 2015, Baltic states housing bubble, British property bubble, Bulgarian property bubble, Chinese property bubble, Danish property bubble, Indian property bubble, Irish property bubble 1999 to 2006, Japanese asset price bubble, Lebanese property bubble, Polish property bubble, Romanian property bubble, Spanish property bubble, United States housing bubble 1997 to 2006, U.S. real estate bubble 2012 present. The Washington Post writer Lisa Sturtevant thinks that the housing market of 2013 was not indicative of a housing bubble. A critical difference between the current market and the overheated market of the middle of last decade is the nature of the mortgage market. Stricter underwriting standards have limited the pool of potential home buyers to those who are most qualified and most likely to be able to pay loans back. The demand this time is based more closely on market fundamentals, and the price growth we've experienced recently is real, or more real. Other recent research indicates that mid-level managers in securitized finance did not exhibit awareness of problems in overall housing markets. Economist David Stockman believes that a second housing bubble was started in 2012 and still inflating as of February 2013. Housing inventory began to dwindle starting in early 2012 as hedge fund investors and private equity firms purchased single-family homes in hopes of renting them out while waiting for a housing rebound. Due to the policies of QE3, mortgage interest rates have been hovering at an all-time low, causing real estate values to rise. Home prices have risen unnaturally as much as 25% within 1 year in metropolitan areas like the San Francisco Bay Area and Las Vegas.